Well, hello, everyone. We're happy to have you join today's webinar, Cutting Through the Noise, as we go through important 2022 planning updates. I'm Nick Breit, partner and director of financial planning at Fiducient Advisors. Happy to be joined by Howard Stone, a partner at FGMK. Howard brings more than 25 years of tax and accounting experience. Howard represents business clients, high net worth clients, and family trusts. Howard, happy to have you on today's webinar.
Thanks, Nick. Happy to be here.
Most of you on today's webinar are likely familiar with Fiducient Advisors, but for those that may not be, we want to give a quick firm at a glance. So 189 associates at Fiducient, 40% of those are investment consultants, 40% of the firm is among research and analytics, and then the remaining 20% on operations and compliance. We oversee $250 billion in assets under advisement across 4 business lines: defined contribution and defined benefit, endowments and foundations, private clients, and financial institutions. At Fiducient, we're very proud of the recognition that we've received from a number of publications and organizations. You can see highlighted here on the screen, including Pensions and Investments, naming us a top 25 worldwide consultant as of last year. So with that, we'll jump into key updates for 2022 and financial planning considerations. We'll walk through key updates, then we'll go through practical planning considerations, and then at the tail end, provided that there's time remaining, we'll answer some questions. So please feel free to use the chat feature provided in the box. So when we talk about financial planning, it's really important to see the bigger picture. And what we mean by that is taking a holistic view and understanding how each of these components really interacts with one another. Our 2022 financial planning guide, which is available on our website, covers all of these in greater detail. Today, we'll start off just going over key updates for 2022. Howard, we find ourselves at a unique point here. We were discussing beforehand that uncertainty probably best describes the predicament that taxpayers find themselves in. Ordinarily would have a good idea in a new tax year what changes might be in effect, how we plan from there. Unfortunately, we just continue to be in a gridlocked environment politically, which means a lot of legislation that had been targeted for passing as of last year in 2021 didn't happen. That most notably being the Buildback Better Act. So in coming months, taxpayers will continue to watch to see whether Buildback Better Act, whether it retains that acronym and moves forward, or some smaller version gains traction, as well as Secure Act 2.0. But to start things off, I think it's helpful to give an overview of Buildback Better Act, just because we continue to get a lot of questions on it, looking at what was in earlier iterations of the proposal, and then looking at perhaps what the House passed as of last November. If we look at what the House passed, it's by no means a guarantee that that might be the form taken up in subsequent legislation, but perhaps points to what might be included in future legislation. So as it relates to individual taxes, there have been a push to perhaps restore the top tax rate to the Pre-Tax Cuts and Jobs Act rate of 39.6% from 37% currently. That proposal was ultimately removed, as well as an increase to the long-term capital gains tax. Both of those proposals being removed in the House version, given strong opposition from Kirsten Sinema out of the state of Arizona. There had been talk on the net investment income tax about expanding the application to trade or business income for taxpayers with AGI north of $400,000. That proposal remains. The solve, as far as if we're not going to raise income taxes for individual income tax rates or on long-term capital gains rates, well, then what's the solve? And that's where the proposal came up, to create a surcharge or surtax for high income earners, as well as on trusts and estates. So the House proposed version would have a 5% surtax on adjusted gross income north of $10 million, with an additional 3% surtax on adjusted gross income north of $25 million. And then a much lower surcharge or surtax would apply on trusts and estates. So a 5% surtax on AGI north of $200,000, with an additional 3% surtax on AGI north of $500,000. And then finally, rounding out the mix, it's important to note that the state and local tax deduction, or what's commonly referred to as SALT, will remain really a sticking point in negotiation. So the House passed version would increase that cap from $10,000 to $80,000 for tax years 2021 to 2030. The cap would then reset to $10,000 in 2031, after which it would expire. So Howard, having done a quick run through of some of those proposals, what jumps out at you as far as areas that taxpayers should be particularly attuned to?
A couple comments on a few of the items. The net investment income tax, so generally that's now applied to passive income, interest, dividends, and passive investors. This, expansion to trade or business income is to tax active owners of flow-through businesses with an additional 3.8% net investment tax. So that is big for business owners if that got passed. On the surcharges, certainly, for individuals, high income, that is a substantial increase in tax, but probably the increase on the trusts would be hit more trusts, where trusts that own own businesses that flow into the trust. Typically, you could see additional taxes on these trusts, because it's only a $200,000 threshold where the surtaxes kick in. So that could, if that passed, that would be a substantial impact on estate planning and business and I would say trust with substantial assets or investments in businesses that flow into the trusts. On the state and local side, the states have already tried to attack this SALT cap, and a number of states have passed legislation, what they call SALT cap workarounds. And mainly that applies to flow through businesses. Partnerships and S corps can get a deduction at the entity level for the shareholder partner share of the tax, and then that credit passes through to the individuals. So we've seen some of that in a number of states, and that's something that business owners should be looking at in planning.
Those are great comments. Thanks, Howard. On the estate planning side, there had been some question as far as whether the estate exclusion and lifetime gift exemption amount might be cut in half beginning as of 2022. So we certainly saw it on our side. I'm sure you did as well, a move by certain high net worth individuals trying to accomplish estate planning prior to year end 2021. With a thought being that the exemption amount could potentially get cut from approximately $12 million per person to $6 million per person. Important to note that proposal was removed from the House passed version this past November. And then there had been a lot of traction in the news and popular media that perhaps any tax legislation would impact grantor trust provisions, which would have pretty far-ranging implications as it relates to intentionally defective grantor trusts or grantor retained annuity trusts, so on and so forth. I think much to the delight of taxpayers, that proposal was also removed. So, important things to keep in mind as far as whether this could potentially get picked up. There's the potential for that, but it doesn't seem like there's an appetite at this time.
Yeah, I would agree with that, Nick. Just to point out, though, the estate tax exemption by law is scheduled to sunset in 2025, as you note here. And so it's still, even if nothing changes, the estate exemption is going to be cut in half starting in 2026, and that's not that far away. So, wealthy individuals who haven't set up trusts to take advantage of the exemptions should still be thinking about doing that in light of the sunset of the 12 million in 2026.
Yeah, it's a great point. So even in a best case scenario, we might be looking at a couple-year planning window.
That's right.
On the retirement side, there are a number of retirement provisions that have been talked about being incorporated as part of a tax package. Interestingly, some of this really ties to last June. There was a ProPublica report that PayPal co-founder Peter Thiel had north of $5 billion in a Roth IRA, which really set off alarm bells in Congress to say, do we need to take a closer look at perhaps some of the provisions governing the retirement plan? So we've just quickly summarized these, as a number of the proposals actually remain in their current form. So first, potentially a provision that would prohibit additional contributions to IRAs for certain high-income taxpayers with more than $10 million in combined retirement account balances. There had been some discussion on banning what's commonly referred to as the backdoor Roth contribution, potentially starting as of January 1st of this year. Taxpayers are a bit in limbo just because that hasn't been passed to this point. So there's some question as far as if this were addressed, would it be addressed on a retroactive basis or would it be applied prospectively? There's been talk about potentially prohibiting Roth conversions for certain high-income taxpayers, but important to note, the House proposal would be to start that in 2032. So for individuals considering Roth conversions, potentially we're looking at another 10 years without any prohibitions on who can actually convert to a Roth. What I thought was particularly interesting is the discussion on mandatory distributions for large retirement account balances. Now, this would start or take effect after 2028 for certain high-income taxpayers. So for those with retirement balances greater than $10 million, who again meet those high-income provisions noted here at the bottom of the page, for balances greater than $10 million, there'd be a required minimum distribution of 50%. And for portions exceeding $20 million, there'd be a 100% distribution requirement for that portion exceeding $20 million. So interesting, certainly something that we'll continue to watch closely. And then finally, rounding out the mix, there had been some consternation about whether alternative investments could continue to be held within IRA accounts or retirement accounts. So there had been some discussion that investors might need to force those out of their IRAs. I think for those that could potentially be impacted, they were delighted to see that proposal was ultimately removed from the House version from this last November. So when we're talking about Buildback Better Act from a broader level, important to note that there's a number of hurdles that certainly still exist to potentially get this through Congress. So first, from a timing perspective, it's important to note that the reconciliation process that would allow the Senate to approve with only a simple majority as opposed to 60 votes, that's only available through September 30th. So we're literally talking less than 7 months. To get approval through both the House and Senate is still, frankly, going to be a high hurdle. Democrats have a very narrow majority in the House at 222 to 212. Democrats can lose no more than 4 votes in the House, assuming no Republican support. And then within the Senate, we continue to remain gridlocked at 50-50. And oh, by the way, sadly, one of the Democratic senators out of New Mexico suffered a stroke in early February. So technically, they don't even have 50 votes as of right now, as the Senate procedures require in-person voting. So the senator is assumed to make a full recovery, but that remains an additional hurdle. And then we continue to see potential wild cards with regard to Senator Joe Manchin of West Virginia and Kyrsten Sinema out of Arizona. So Howard, I guess if we take a step back, what's the realistic probability of some of these things getting through both the House and Senate?
I think it's going to be tough to pass a broad legislation. They may get something through piecemeal. I mean, part of the thing is really, and Joe Manchin just commented after the president's address the other night, that really nothing's changed. He's against deficit, further spending without, tax increases. And he talks about increasing tax rates, capital gains, corporate rates, and Kyrsten Sinema is against raising rates. So between the two of them, it's kind of gridlocked. Between the two of them, they need their votes and they don't even agree on what should be done. So I think it's going to be very difficult to get comprehensive legislation passed.
Yeah, I saw Manchin's comments. He basically said that he thought that tax rates should be increased on the wealthy and corporations, and his end goal for those that may not be aware, or his latest comments, I should say, would be half of that amount would be devoted to fighting inflation and lowering the deficit. And then the remaining half being targeted towards climate, and then social spending issues would really take a backseat as far as whatever money would be left over. So, I think as you aptly summarized, Howard, we continue to be very much in a state of gridlock and calls into question what might actually get passed. Also important to note, we had spent some time covering the state and local tax deduction. So as we've noted here, no SALT, no deal, which has been the refrain from the SALT caucus, which has more than 30 members in the House of Representatives. So again, continues to be a sticking point in negotiations. The House passed version from this past November would increase the SALT cap from $10,000 to $80,000. But even that remains a question mark and faces opposition in the Senate, with Senators Sanders and Menendez out of New Jersey saying that there should be certain income testing provisions rather than just fully increasing that cap from $10,000 to $80,000. And then, oh, by the way, as we've rounding out the mix, there's other legislative priorities at works as well. So from a government funding standpoint, we've been in a bit of a patchwork situation since this past October, with continuing resolutions passed every couple months to avoid a government shutdown. The most recent batch would expire March 11th. So Congress is hoping to take a vote next week as of March 8th. To pass a spending bill that would keep the government open, but there's the potential that perhaps we see another continuing resolution to buy a couple months' time. We need to find a replacement for Supreme Court Justice Breyer, who announced his retirement recently. For some perspective, over the last couple of years, the nomination process has typically taken 2 to 3 months. So, with the thought being that we're in a midterm election year, that's pretty significant, given the time potentially devoted to naming a Supreme Court justice. And oh, by the way, Democratic leadership certainly will want to make sure that a new justice is confirmed before the midterm election. And then finally, obviously, the sad unfolding situation out of Russia and Ukraine, what that means from congressional action and attention. So most recently, I saw the White House has requested Congress to approve a $10 billion emergency aid package for Ukraine. So, I think as we're summarizing it, there's clearly a lot of things here that are competing for congressional attention. So, Buildback Better Act is certainly seems unlikely as far as the provisions that we've seen to date. The reality is that it might get broken up into several different pieces. And then I think, underscoring the current climate, Senate Majority Whip Dick Durbin recently said that he views anything that would get passed to really be found money, in his words, and that the outlook is fairly pessimistic. So remains to be seen what might gain traction in future months, but that's a quick recap on Build Back Better Act. On the retirement side, there's been talk about Secure Act 2.0. So the Secure Act was passed back in 2019. So some of the provisions that are potentially going to gain broad bipartisan support would be increasing the age for required minimum distributions, which is currently 72. There's a push in both the House and Senate to potentially push the RMD age out to age 75. There's a push to increase catch-up retirement contributions for those over age 50, and also to index to inflation the catch-up contribution limit for IRAs. There's some discussion on reducing RMD penalties, so long as a taxpayer acts quickly to correct any errors. And then on the business side, some features as it relates to auto enrollments for 401k plans requiring employers start an employee's contribution at 3% and gradually move that up to 10% over time, and then increase tax credits for retirement plans for small business startups. As far as other updates are concerned, we already addressed the backdoor Roth contributions and Roth conversions. We continue to note to individuals that there's new RMD tables for 2022. The good news there is that it's a larger RMD divisor, which in turn results in a smaller RMD on a percentage basis. And then on the adjusted gross income limitation for charitable gifts, as a quick reminder, the CARES Act had increased the potential AGI deduction up to 100% for cash contributions made to public charities. That expired at the end of 2021. So barring any extension of that former provision, the current AGI limitation goes back to 60% for cash donations to public charities. So with that, Howard, I think it's a good time to pivot into practical planning considerations for individuals. We walked through Buildback Better Act, some retirement legislation, but let's cover some areas that individuals can keep in mind from a planning perspective.
Well, thanks, Nick. I mean, in the tax planning area, loss harvesting is always something to look at to offset capital gains or future capital gains. Charitable gifting for people who may not be itemizing their deductions. You have to have substantial charitable contributions to get to be able to itemize. And so what some people are doing is pre-funding charitable contributions into donor advised funds or private foundations and getting increasing their deductions enough one year to get the benefit of the charitable deductions, and then paying out to the charities over a period of years to make their annual charitable contribution. So that's what we call bunching of charitable contributions to take advantage of itemized deduction limits otherwise. And the main reason for that limit is that the SALT cap at 10,000, and many older people have paid off their homes, so they don't have mortgage interest deductions either. So there are good strategies in the charitable gift area to try to bunch your charities into 1 year and then pay out of a donor advised fund over a period of years. In the estate planning, again, we talked about the $12 million exemption, lifetime exemption, scheduled to, basically get cut in half in 2026. So people should still be looking at their estate planning and then, making their annual exclusion gifts of $16,000. So between a husband and a wife, you can gift $32,000 to any individual. So between children and grandchildren, sometimes you can make substantial exclusion gifts that don't eat into your lifetime exemption.
And that can be substantial. I mean, that's really a layup from a planning perspective if you're doing that over a number of years.
That's right, Nick. And so there's the grantor trust planning. It gets complicated, but there can be substantial savings in some of the grantor trust areas. Then you, on the estate planning, the portability. So remember, husband and wives can pass their unused exemption on to the other spouse. But you should be considering the state tax exempt, what the state estates, which states tax estates and which ones don't, and be cognizant of planning for states like Illinois that have basically a $4 million exemption as opposed to a $12 million exemption. And then you also want to be constantly looking at your IRA plans and your plans at work to make sure you've got the right beneficiary designations, whether it be individuals or trusts that you want to designate. So you always want to look at that on a regular basis to make sure the beneficiary you named 10 years ago is still the beneficiary you want today.
From an investment planning standpoint, Howard already hit loss harvesting, which has crossover between taxes and in investments, given the market volatility that we've seen, particularly pick up over the last month or so. Recently purchased investments might now be at a loss, which gives you an opportunity to harvest that loss to offset those gains, which Howard referenced. Just be careful of the wash sale rule there. The pickup in volatility that we've seen over the last month is really a good reminder for investors to revisit their longer term objectives and overall risk tolerance. We've clearly been in a very favorable environment for stocks for quite a period of time, and the dislocation or shakeup that we've seen here most recently really is a good reminder that investors should not become agnostic with regard to risk. We continue to underscore the importance of asset location. So looking at how assets are placed among taxable and tax deferred investment accounts can have a meaningful impact on a portfolio's after-tax return. And then from a retirement planning perspective, evaluate whether to do a Roth conversion. For individuals that aren't in the top 37% federal income tax bracket, that might mean doing a partial Roth conversion where you convert up to a certain tax bracket and then do partial Roth conversions over a period of years. Potentially consider a backdoor Roth contribution if you're a high income individual that would otherwise be precluded from adding or contributing to a Roth. Important to note that there's a large caveat. It depends if you have other traditional IRA balances that really fouls up the calculation. So you need to be careful there as far as whether to pursue a backdoor Roth contribution. We continue to remind individuals of the new 10-year window, the stretch IRA rules for inherited IRAs. And then finally, a number of clients, we're certainly seeing migration from high income tax and high property tax states as far as establishing domicile or residency in a new state. Important to note that days in and days out is an important part of that calculation, but not the only box to check as far as establishing a new residency. So important to note that. Howard, anything you'd add there, whether it be on the domicile side or retirement planning side?
Well, a few comments on Roth conversions. I think for the less wealthy, you make a good point about possibly timing those conversions over a period of years. For the very wealthy, who will probably never need their IRA retirement money, the Roth conversion is usually a no-brainer. A lot depends on your income tax bracket and what type of returns you're getting in your IRAs, but we usually find that the very wealthy who don't need their IRA accounts, a Roth conversion makes a lot of sense, because not only don't you ever pay tax again on the Roth, but you get the compounding through your death, and then under the 10-year inheritance rule, you can defer that out, payments out another 10 years. So you get a lot of compounding of earnings for many, many years. If you convert, let's say if you're 60 and you convert, you could get 40 years of compounding tax-free earnings. So that's something everybody should consider. On domicile, I agree with you. You have to not look at just time spent, but the facts and circumstances. And also, it's possible that spouses can be residents of different states. And so you can have one spouse living in Florida who has most of the taxable income in the estate, so to speak, and maybe the other spouse lives in another state. And we do see this sometimes. So be cognizant of it. Both spouses don't need to be residents of the same state, but if they're not and one's in the taxable state, sometimes moving assets around between the spouses can minimize the state income taxes.
All great planning points. Well, for additional insights, please visit our website. Look under the Insights tab to find a copy of our comprehensive 2022 financial planning guide and other important and timely updates. Howard, really appreciate your time on today's webinar. I think a lot of food for thought for taxpayers to keep in mind, as well as practical planning considerations. And thanks to everyone for participating on today's webinar.